Howdy everybody, I'm Gary and this is GLoPersonalFinance, where I talk about getting your finances under control, building wealth, becoming financially independent. In this video, I want to talk about one part of doing your due diligence on getting a property. When you first want to get into real estate, just buying a property doesn't mean it's a good deal. So I want to walk you through my very first steps when deciding to move on with purchasing a property, the cash-on-cash analysis. Now I want you guys to keep in mind, these are just rough numbers for when I look at a property. I'm making a few assumptions on taxes paid, how much repairs I'm going to do, or running expenditures. Once I decide the math is approximately good enough, I'll do a bit more research on the property and input more finite numbers. So let's head on over to my computer. Alrighty everybody, I want to go through one of the first things that I do whenever I see a property that I want to buy. So I just picked a random property on Roofstock. This property right here, it's Lawton, Oklahoma. The purchase price is $79,000. I'm not going to pay, so I'm going to probably put an offer of $78,000, maybe $77,000. Depending on what I see, but I'm just going to do a quick calculation on what if I put an offer for $78,000. Okay, so I'm going to run you through this little cash-on-cash return worksheet that I've made up. I actually got this worksheet off of Bigger Pockets, and I put it on a spreadsheet to let it suit my needs. Okay, because I love spreadsheets. So first thing I did a little screen grab of the property straight off of Roofstock. I just screen grabbed this, put it right here so I can see the property, put the address right here so I can have the address that I refer to. Purchase price I have right here at $78,000. I thought to myself, I was like, my down payment, I'm gonna put 25% down. I'm 5% down on this property, which equates to about $19,500. Now let's go through this worksheet really fast. Income. This box right here, top left, income box is the box of where I am collecting money. So some landlords, obviously they collect money on rental, but they sometimes have a laundry room, a coin machine laundry room, so they can collect money in that way. Storage facilities on property that sometimes they have tenants pay for storage, and other miscellaneous add-ons that you could potentially get. I'm not going to get laundry, storage, or any miscellaneous, so I'm going to leave those all at zero. But rental property, there's already a tenant in this property, and tenant pays, in this case, $750 on this property. So I'm going to put that, since there's a tenant already in there, $750. Okay. Alrighty, let's move on to the next box. This next box of expenses. As you can see, everything updates the total monthly income. It's just the total of this green box right here. Now the expenses, there's a good amount of expenses. Typically here is what property owners pay. They pay property taxes, homeowners insurance, water, sewer, electric, gas, HOA dues, lawn or snow, vacancy rates, repairs, capex, property management, and ultimately finally your mortgage. Now we're going to go through all of these. I'm going to explain what all these are. There's some terms in here that might be a little confusing, but we'll talk about that soon. Okay, so property taxes. Now I can go straight to the Oklahoma website, the property tax assessor, and I can get that information from there. But I think Zillow, I got this information off of Zillow. Let's go to Zillow really fast. Now, Zillow in 2019, they paid $712 for this property. All right. I'm not quite sure where they got that number, but that's totally fine. I'll probably use about 800 just to play it safe. Okay. Interestingly enough, on Roofstock, they budgeted about $1,000 for property tax. So I'm going to split it down the middle. I'm going to say probably just 850. 850 would be a good estimation for property tax. Let's just make 900 just to be safe. 900. This would be a conservative amount. Now, homeowners insurance, I could go to various companies and get a quote for this address, but again, I'm just going to head on over to Roofstock and see what they average on homeowners insurance. 720. They think 720 is a good estimation for homeowners insurance. 720. Okay. Now these are yearly These are yearly estimates. So what I have to do now is I got to change that into monthly because I'm going to do a monthly cash flow. So I'm going to change this, write a little equation, 900 divided by 12. That gives me $75 per month. And then 720 divided by 12, put a little equation here, equals 720 divided by 12. That gets me $60 per month. Now, water, garbage, electric, gas, all of those typically, sometimes landlords pay it, but in this case, I'm gonna have my tenants pay all these. So I'm just gonna leave those all at zero. HOA costs, Roofstock says there's no HOA costs in this situation, so I'm gonna leave that at zero. Lawn and snow maintenance, I'm gonna leave that up to the tenant to do also. Now, vacancy rate. Vacancy rate is the time that our property sits empty, right? I know we don't want that to happen, but it happens, right? People move on, they go to other places, and our property is going to sit empty for X amount of time. Now, how often does that happen? Yeah, I don't know. So what you could do is you can go to any data site for your specific region that you're trying to buy. So I can go to any data site for Lawton, Oklahoma, and with this zip code, and I can look up the vacancy rate of a typical rental home. There are many places that you can do this, but on average, 5% is a vacancy rate that I feel comfortable using. So 5% of 750. So I'm going to do that quick calculation. 5% of 750. So 750 times 0.05. Okay, it gives me $37.50. Okay, now repairs. Are there any ongoing maintenance that you have to repair? So if there's like maybe the toilet suddenly explodes, or all of a sudden there's mice eating the drywall, right? There's many types of repairs that can happen, right? So I like to typically budget about between $75 and $100 per month for ongoing maintenance of the property. So let's just go in the high end. Let's go 75 to 100. Let's go $90 per month for ongoing maintenance. Now, CapEx. This is the big purchase. The replacement of your washer and dryer. This is the replacement of microwaves, roofs, any HVAC systems in the house, and any big items that you got to replace. The foundation of the house. There's tons of things that could go wrong throughout the life of you owning this property. So capital expenditures are for the bigger purchases, are like the one-time $5,000 payments that you got to make to do the whole heating system in the house, because the heater suddenly stops working. You don't want to pay $5,000 all at once, right? So you got to budget it throughout each of those months. So I like to budget around $100 in this case, just in case, and I'm just going to take that $100 and put it in a separate account, and just in case something happens, I can use that money to do those big repairs. So a capital expenditures of $100 is fairly safe. Now, property managers typically take somewhere between 6 to 12% of your monthly rent. So I like to budget maybe 10%. 10% is a nice conservative amount. Obviously, you would have to go interview property managers yourself. You would have to see which property managers are a good fit for your specific property, and if they work well for you. You get what you pay for with property managers. Budgeting 10%, I think, is a pretty safe number. Okay, all these numbers can adjust once you get everything finalized, but we're just doing an initial assessment of a random property off of Roofstock. So property management, let's do 10% of your monthly. Writing a little equation on this, equal 10% of your monthly, 0.1. 0.1. There you go. So $75 per month. Now, mortgage. We're going to be borrowing money from the bank, right? I'm putting 25% down, so I'm going to be borrowing $58,500 from the bank. So I'm going to go head on over to biggerpockets.com and put some information in here. My loan amount is $58,500. My loan period is 30 years. With an interest rate, we're not going to get the low interest rates as if you're living at that property. This is an investment property, so typically you'll get higher interest rates. So I'm going to estimate 4.25. Heck, let's make it 4.15. Maybe we can get an interest rate right there. Okay. Annual taxes is annual insurance. I've already calculated, so I'm not going to include those. I am going to include those eventually in my escrow, but right now I'm not going to. I just need the monthly payment. So this tells me $284.37. I'm going to be paying my loan back at $284.37. So let's head back to my cash on cash. $284.37. $284.37. I think that was the number. Good. So what we have right now is head on over to this third box for monthly cash flow. Let's see how much additional I'm going to be making per month on this property. So my monthly income is $750. My monthly expenses is $721.87 per month, which nets me a monthly cash flow of $28.13. Over the year, multiply this number by 12, and this gives me how much cash flow I'm getting at the end of the year, $337.56. Now, this is a fairly low cash flow from the calculations that I'm doing. So we can do a few things, right? If I want to bump up my cash flow a little bit, maybe I can charge a little bit more rent, right? Maybe instead of charging $750, I got to charge $775 because I'm a new landlord, and you're not going to be paying your old rate again. So maybe $775, okay, per month. Maybe I'm budgeting a little too much for repairs and capital expenditures, so I can go a little less on that. Maybe instead of 100, I could do 90. Instead of 90, I maybe do 85 per month. Okay, so now that bumps up my cash flow to around $65 per month, or $787 per year. Okay, let's see what this gets us, because what I'm going to do now is I've put money into this. I put about $19,500 into this property. I want to see if maybe I would have taken this money and invested it in the stock market, would I have gotten better returns? So let's go ahead and make that calculation really fast. So my down payment was $19,500. Closing costs, I haven't put closing costs in yet, but a closing cost for this typical loan, probably about $3,000 worth of closing costs. I'm not going to do any immediate rehabilitation repairs on this property since there's a person living in there already. So I'm going to leave that zero. Miscellaneous other expenditures, I'm going to leave that at zero also. So my total investment that I'm putting into this property is $22,500. And then so my annual cash flow, which was $787 divided by how much I'm putting in, gives me a return of 0.035 or 3.5%. Now, what that 3.5% is telling me is that that's the money I'm getting back for my initial investment. Yeah, given that an index fund averages around 6 to 7%, putting this money into an index fund would have yielded me probably double the amount that I'm getting off of this house. So I'm looking at this, and this is telling me, this cash flow and this cash on cash return is telling me that this property is probably not a good fit for me, right? It might be a good fit for somebody else, but for me, in my situation, this is the amount of money that I'm investing and the amount of return that I'm getting isn't doing me so well. Okay, now there's other things to consider if you're into this property just for the cash flow, which is one of my goals, is to get good amount of cash flow. But if you're looking at this property, you can see right here the appreciation of this property is 3.3%. So there's other avenues of getting money also. Not only are you getting money from the cash flow, but you can also get money from the appreciation of the property. So in this case, obviously, if you buy at $78,000 and then you sell it 10 years down the line, maybe it bumps up to maybe $90,000. You're making money on the appreciation. Also, that this is not considering, that this 3.5% is not considering. That appreciation money that you get from selling a property, those unrealized gains, would be another video that I'm doing. But I'm looking right now, this is just one of the calculations that I'm doing. One of the calculations to consider when I'm looking at a rental property is the cash on cash return and the total monthly cash flow. Personally, for me, I'm looking for a cash flow. I'm looking for a cash on cash return above 7% that I can beat the S&P 500, right? And a monthly cash flow probably around upper 100s, lower 200s, mid 200s. That would be the area that I'm personally looking for when I'm looking into a property. Hopefully you guys found this helpful. Hopefully you guys see a little bit of my thought process while I'm looking at a property and I'm doing all the numbers and seeing if all the numbers line up for me to actually make an offer on a property. Hopefully I can find a property that actually does cash flow very well, and hopefully I'll be making a video on that one soon, but I got to find that property. You got to hunt for these properties. Hopefully you guys found this useful. Comment below to see if there's any questions or any comments that or any calculations that I missed. Let me know what you guys think. I hope you guys like this video. I'm planning to do a whole series on investment property. This is just one initial analysis on an investment. There are many other things to consider. The tax savings you get when buying an investment property. $100 made in rental income is taxed differently than $100 made at your job. The appreciation of a property over time. Buying your house for $90,000 and 10 to 15 years later, it's worth maybe $120,000. And also the fact that you have your tenant paying down the debt you borrowed from the bank. These are topics for another video. I just wanted to show you my personal first steps when looking over the math to see if I want to pursue a property. I hope you learned a lot from this video. Stay tuned for the rest of this series, and I look forward to having guest speakers who made real estate their passion. Please like and subscribe to my channel. Stay safe out there, and I'll see y'all next time.